The heir to the Cartier jewelry firm has been accused of laundering proceeds through USDT. The United States authorities have arrested the heir to the Cartier jewelry empire, charging him with conspiring to launder proceeds obtained from the illegal drug trade using Tether, USDT. Law enforcement in Miami arrested Maximilien de Hoop Cartier, a direct descendant of Louis Cartier, the founder of the company that manufactures luxury watches, necklaces, and bracelets, on suspicion of collaborating with a Colombian drug cartel. Along with 5 Colombian citizens, Cartier attempted to import 100 kilograms of cocaine and launder hundreds of millions of dollars, mainly through over-the-counter, OTC, transactions with USDT. During this time, the criminals managed to launder only $14.5 million. Currently, Cartier is being held in a detention center in Miami, while his accomplices are in Colombian prisons. According to the indictment, to implement his scheme, Cartier established shell companies and provided financial institutions with false information that they were allegedly engaged in software and technology. He then used his company's accounts to conduct unlicensed money transfers. Using USDT, dollars, pesos, and other currencies, Cartier laundered hundreds of millions of dollars of criminal proceeds. Holding Argentine citizenship, Cartier spent most of his life in France. He has been charged with 4 counts: money laundering and conspiracy to launder money, transactions involving property derived from illegal activities, and operating an unlicensed money transfer system. Jeweler Louis Francis Cartier founded his luxury brand in Paris in 1847. As for Maximilien Cartier, he previously owned the company Patagonia, which is engaged in the production of wine, beer, and bottled water. Yuga Labs has partnered with Somnia to optimize the Other Side metaverse. Yuga Labs, the company behind the popular NFT collection board Ape Yacht Club, BAYC, has announced an innovative collaboration with the firm Somnia, which has developed a first-level L1 blockchain specifically for the metaverse. The collaboration is intended to significantly improve interaction between the vast digital spaces of the Yuga Labs metaverse called Other Side. Somnia's high-performance L1 blockchain and innovative omni-chain protocol support hundreds of millions of transactions per second, setting a new standard for interaction in the metaverse and gaming ecosystem. Using these technologies, Yuga Labs will provide NFT owners from its collections with enhanced capabilities and new incentives. The partnership will allow for the integration of the Somnia protocol into the Other Side metaverse, enhancing the functionality of digital assets. Owners of non-fungible tokens from Yuga's collections will now be able to showcase their NFTs, complete quests, and earn bonus points on the newly launched Metaverse browser, a decentralized portal similar to popular gaming platforms like Steam. The browser simplifies user interaction with metaverses and applications in the Somnia ecosystem. Its open design promises to significantly expand the user experience, allowing content creators to freely host their applications. Our collaboration with Yuga is aimed at expanding the NFT ecosystem, offering their owners not just useful opportunities, but a gateway to an exciting, interactive experience that pushes the boundaries of NFT possibilities, commented Paul Thomas, the founder of Somnia. The number of Ripple and Uniswap addresses is growing again, a bullish signal for XRP and Uni. Ripple, XRP, and Uniswap, Uni, are showing a significant increase in the number of new addresses. This growth reflects increased investor interest in both cryptocurrencies and a surge in market activity. Over the last 6 months, the number of non-zero Ripple addresses has increased by 7%, reaching 5.2 million. According to the analytics platform Santiment, this growth may reflect broader recognition of XRP as a financial asset, attracting new investors to the ecosystem. According to XRP Ledger data, the total wallet reserves amount to 59.77 billion tokens. Interestingly, only a small portion of these addresses, about 1939, have a zero balance. The number of new Uniswap wallets has increased by 140% over the last year, from 3.03 million addresses in May 2023 to 7.26 million today. Over the last year, Uniswap wallets have more than doubled. This surge coincided with Uniswap surpassing the historic mark of $2 trillion in total trading volume in early April, stated one well-known member of the crypto community. Uniswap not only leads in trading volume among DEXs, significantly outpacing its nearest competitor PancakeSwap, but also maintains the lead in total value locked. TVL of the platform is $5.31 billion. Pension funds are exploring the possibility of investing in Bitcoin ETFs. Significant changes are occurring in the financial sector. Pension funds are beginning to explore cryptocurrency investments. This trend is driven by the recent approval of spot exchange-traded funds, ETFs, for Bitcoin. Manuel Nordist, Vice President of Digital Assets at Fidelity, discussed the growing interest of institutional investors in cryptocurrency-based financial products. We are now beginning to negotiate with major institutional investors dealing with real money, and we are getting some of these clients, as well as corporations and so on, Nordist said. BlackRock also noted increased educational engagement with pension funds regarding Bitcoin ETFs. The potential impact of such investments is very large. Given the total value of assets exceeding $4 trillion, even a modest shift by U.S. pension funds into BTC could direct significant capital into the cryptocurrency market. Traditionally, pension funds have been cautious, staying on the sidelines due to strict risk management protocols. However, changes seem to be near. If pension funds follow the lead of more agile investors, such as family offices and hedge funds, which have already started investing in Bitcoin, this could signify a serious step toward mass adoption of cryptocurrencies. A recent survey conducted by Fidelity Digital Assets shows a division in market sentiment regarding the integration of cryptocurrencies into traditional portfolios. About 80% of wealthy individuals are optimistic about digital assets, while only 23% of pension funds feel the same. Smaller, but sophisticated investors, such as family offices, are more active in crypto investments because they can quickly adapt to new opportunities, unlike pension funds, which prefer to carefully consider each decision, Nordist explained. Nevertheless, spot Bitcoin ETFs offer a familiar investment tool that may ease pension funds' hesitations about entering the cryptocurrency market. The continuous printing of money in the U.S. has advantageously highlighted limited Bitcoin. Recently, a documentary titled Finding the Money was released in the U.S., in which Jared Bernstein, the chairman of the Council of Economic Advisors and a key advisor to President Biden on economic policy, made controversial statements about the U.S. government's ability to print money. The U.S. government cannot go bankrupt because we can print our own money, Bernstein said. In the documentary, which explores the theme of budget financing, spending, and public debt, an interview with Bernstein is shown where he attempts to articulate his understanding of economics. The government definitely prints money and definitely borrows it, so the government definitely prints money and then borrows it again by selling bonds. Yes, they sell bonds. Because they sell bonds, and people buy bonds and lend them money. With the reignited debate, Bitcoin has once again come into focus. Proponents of the digital currency argue that its limited supply of 21 million coins can protect against the consequences of the money printing and inflation. Proponents of Bitcoin argue that, as countries' governments continue to accumulate debts and resort to printing money to finance public expenditures, Bitcoin's independence from central bank policies can make it an attractive alternative for investors looking to protect their wealth. Bitcoin Pool Marathon has set a new record for the size of the mined block. The Mining Pool Marathon is again celebrating an important event, the mining of the largest block ever registered in the Bitcoin blockchain. This is block 841,886, which demonstrated the decentralized technological stack called Logos and included only 4 transactions. For its work, Marathon received a reward of 3.169771148 BTC, including 0.044771148 BTC, or $2,654.55, in transaction fees. This block broke the previous record set by block 832849, which was associated with the Runestone Ordinal project, as well as the Leading the Ordinal show and the founder of the project ORD.io, known as Leonidas. Block 832849 with the Runestone inscription contained a total of 7 transactions. If the size of block 832849 was 3.990 megabytes MB, then the block containing the Logos manifesto reached 3.993 megabytes. The key factor for the appearance of these exceptionally large blocks was the ongoing enthusiasm for ordinals in the Bitcoin blockchain. This trend began in February 2023, when the mining pool Luxor mined a block size of 3.96 megabytes, which included an image from the Taproot Wizards project. At the end of March, the Marathon pool once again made history by mining block 836,361 with an image of the letter M, created by ordering transactions according to a specific pattern. Despite this, the size of the block was only 1.72 megabytes and included 8,320 transactions.